My name is Linda, and I will be your host for this morning. On behalf of the Energy Market Authority, I would like to welcome you to the Southeast Asian launch of the International Energy Agency's report, Developing a Natural Gas Trading Hub in Asia. And now, to commence today's program, I would like to invite Mr. Chee Hong Tat, Chief Executive of the Energy Market Authority, to deliver his welcome remarks. Mr. Chee, please.
Thank you, Linda. Mr. Laszlo Barrow, Head of Gas, Coal and Power Division, International Energy Agency, Your Excellencies, distinguished guests, ladies and gentlemen. Very good morning to all of you. We're very happy, I think, to have a very good turnout this morning's launch of the IEA report. On behalf of the Energy Market Authority of Singapore, I'd like to welcome all of you to this Southeast Asian launch of the IEA's report on developing a natural gas trading hub in Asia. At the Singapore International Energy Week in October 2012, the IEA's Executive Director, Ms. Maria Vanderhoeven, said, and I quote, "Despite the volume of its gas consumption and trade, one fundamental thing is missing in this region: trading hubs, where natural gas will be priced not in relation to oil, but depending on regional supply and demand fundamentals." End quote. The IEA report, which will be presented by Mr. Barrow this morning, responds directly to Ms. Vanderhoeven's comment. It assesses the viability of a competitive gas market in Asia and whether there will be a gradual shift away from the current oil index pricing model. The report also draws on experiences in Europe and North America, where gas trading activities are more established and better developed, to suggest some changes to support the growth of the secondary gas market in Asia. The issues raised in the IEA report are relevant to Singapore. Like other Asian economies, we would benefit from having greater flexibility and diversity in terms of contract duration and pricing models. For those of you who may not be familiar with Singapore's situation, our current gas supplies are provided through pipes from Malaysia and Indonesia, and these are all long-term take-or-pay contracts indexed to high sulfur fuel oil. In the second quarter of this year, our LNG terminal will start, and so the introduction of LNG gives us more options, I think, to look for greater flexibility and diversification in terms of supply sources, as well as different types of contract durations and pricing models. So while we remain open to having some of our gas supplies come from long-term oil index contracts, it would be useful for Singapore to build up a diversified gas portfolio comprising reliable and price-competitive supplies from different sources around the world. And we can do this with LNG, and this especially with the market developing and changing over the next few years, where we see a lot of new supplies coming from different parts of the world: North America, Australia, East Africa. I think this creates a lot of opportunities for us to be able to benefit from these changes in the market. So by having a diversified gas portfolio, we avoid being overly exposed to a particular supply source or a particular price index, whether this is the price of oil or, for that matter, even the US Henry Hub price. You would prefer to have a diversified portfolio than to be overly exposed to any particular supply source or price index. This portfolio approach is also the strategy adopted by other Asian economies. The IEA report also suggests that Singapore could play a key role in establishing an Asian gas trading hub. Now, we have seen a steady growth in the presence of major trading houses and industry players, such as Shell, BP, Gazprom, amongst others, who are interested to use Singapore as a hub for their business in the region. Shell, for example, has decided to locate their global gas operations in Singapore. EMA welcomes these developments, and we look forward to working with our industry partners to grow their LNG-related activities. One important infrastructure that will support and enhance the development of an Asian gas price index is to have a network of interconnected gas pipelines in the region. I was having a chat with Mr. Barrow earlier, and I agree with him that LNG will continue to play a very important role in this part of the world due to the geography. But if we have a good network of gas pipelines like what is found in North America and Europe, it will certainly help to further enhance the development of the gas market and the development of the gas price index in Asia. Some of you may be aware that one of the key projects that ASEAN member states are pushing for is the development of a trans-ASEAN gas pipeline. And we hope that this project will be accelerated for the mutual benefit of countries in the region. We're therefore very pleased that the IEA has chosen to hold the Southeast Asian launch of this report in Singapore. Please allow me to now briefly introduce our speaker for today, Mr. Laszlo Barrow. He is the head of the Gas, Coal and Power Division of the IEA. He oversees the analysis of gas, coal and electricity markets and policy developments at the IEA. Prior to joining the IEA, Mr. Barrow was responsible for the demand and price forecasting and investment capital allocation at MOL Group, an integrated energy company. He also has many years of experience in government, serving as head of economics and price regulation at the Hungarian Energy Office, which I understand is the counterpart of EMA in Hungary. So ladies and gentlemen, please join me in welcoming Mr. Barrow on stage to deliver his address. Mr. Barrow, please.
Ladies and gentlemen, thank you very much for the kind invitation. This is my first time in Singapore, so I'm very excited to be here with this very, very important topic. To start the analysis of how we develop our competitive gas trading hub in Asia, first let's emphasize that this decade natural gas is joining the club. Natural gas is joining the club of iron ore, coal, oil, copper, and many other commodities where global demand developments and global markets are increasingly determined by the Asia-Pacific region. This is a relatively recent development. If you go back 10 years in time, 10 years ago, natural gas in Asia was not very important. Of course, Singapore was already using natural gas. Of course, Malaysia and Indonesia were already important producers, and they were exporting to Japan and South Korea. But the Asia-Pacific region was very much self-sufficient in the exports of Malaysia and Indonesia, enough to supply Korea and Japan. And natural gas played a marginal role in the Asian economies. But this is changing rapidly. In fact, what you see is that currently the Asia-Pacific region is responsible for around 40% of the global demand of natural gas. Now, you hear a lot about the shale gas revolution in the United States, and that is very, very important. And low gas prices in the United States trigger a rapid increase of the use of natural gas in the United States, but actually gas demand growth in the Asia-Pacific is considerably faster than gas demand growth in the United States. So in terms of the global demand picture, the Asia-Pacific plays a bigger role in growing gas demand than the US, despite the shale gas revolution. And very importantly, in the entire Asia-Pacific region, China is the only country which has a meaningful increase in its domestic production. China is developing its domestic gas resources. If you look around the Asia-Pacific region, first, the traditional exporters, Malaysia and Indonesia, are having difficulties with their major depleting fields. Indonesian exports are actually falling quite significantly. Malaysia keeps up, but roughly at the same level. India does have upstream potential, but they also have a long list of difficulties. those upstream resources. So basically, China is the only country which has a growth of domestic gas production. And given the size and scale of the Chinese energy system, we had very, very different scenarios for Chinese domestic gas production growth. And then we even had a scenario called the Golden Rules case where we really, really stretched our vegetation. And even in that case, Chinese import needs are increasing. We could not create a mathematically consistent scenario in which Chinese gas import needs are not increasing. Another important characteristic of the region is that, again, China is the only country which has a realistic strategic prospect of large-scale pipeline imports from outside the Asia-Pacific region. China already has a pipeline interconnection with Turkmenistan, and there are serious negotiations between China and Russia about East Siberian pipeline projects. Now, of course, it would be very difficult to predict how long it will take for China and Russia to agree, but that's certainly a technically feasible option. I say that for the other pipeline projects which you read about, which would bring gas by pipeline from outside Asia Pacific, projects like Turkmenistan, Afghanistan, Pakistan, India, or Russia, North Korea, South Korea. If you take a look at the list of the countries, you have to have some really, really optimistic political assumptions for these projects to materialize. So given that we have a rapidly growing gas demand in the Asia-Pacific region. The only one place, China, with an increasing domestic production, but that's not enough even for China. And very serious obstacles for pipeline projects into the region. It's very, very clear that liquefied natural gas will play an increasingly important role in supplying the Asia-Pacific. In fact, the gas demand growth is so rapid, it's rapid that currently the largest investment project in the world economy is Gorgon LNG in Australia. That's not the largest LNG investment project, that's the largest investment project anywhere in the world economy, in any industry, a $52 billion project. I mean, this number is growing every day because of the cost inflation and cost overruns. But Gorgon LNG will be sufficient to supply the growth of Asian gas demand for 6 months. So on average, we will need an LNG project the size of Gorgon in every 6 months coming online in order to supply the Asia-Pacific region. In fact, that hasn't happened in the past 1 or 2 years. In fact, in the past 2 years, the most important source of LNG supply to Asia was the Eurozone crisis. Because of the Eurozone crisis and the European recession, European gas demand is falling like a brick, and as a result, Europe imports less energy, so the existing energy supply can sell more to Asia. Now, you might say that the Eurozone crisis will last forever, and that's a stable supply source for Asia. But as a European, I very much hope that that will not be the case. So one day Europe will get back to a growing economy. Now, the other important aspect of the Asia-Pacific region is the almost complete dominance of oil price indexation. Now, the oil price indexation made actually perfect sense when the industry was first developed. For several decades, gas was the ugly duckling of the oil industry. The saying in the oil industry was, after an exploration project, that unfortunately we did not find any oil, but luckily we did not find gas either. Gas was regarded as an undesirable byproduct of oil production, and routinely it was flared off in oil fields. At the same time, on the demand side, conventional power generation capacities could rapidly shift between gas and oil, so there was a strong physical substitution between the two fuels. So linking the price of gas to the price of oil made perfect sense, both from a production point of view and also from a demand point of view. And also, I should also add that when these contracts were developed, then the oil price fluctuations were fluctuations between $20 and $25 per barrel. And if you plug that to a gas pricing model, it doesn't really matter. The $100 per barrel oil price, again, 10 years ago, it was just simply not on the radar screen. I mean, as a young economic economist Torkel, my first energy-related job was advising the Hungarian government when Russia offered Hungary a $28 per barrel ceiling in the oil price index contract because they were concerned about the $10 per barrel oil price. That offer was, of course, rejected out of hand by the Hungarian government because, as we all know, oil prices will never go over $25 per barrel. I mean, that was the dominant expectation just 10 years ago. So $100 per barrel oil price really changes the economics of this game. Now, in the Asia-Pacific region, there is an increase in spot trading. There are developments of markets. But the total volume of gas traded by oil price indexation is still increasing. So its share went down from 95% to 86%, but due to the total size of the market growing rapidly, the volume of oil price indexation is still increasing. Now this contrasts heavily with the other two main regions. The United States never had oil price indexation. Now, the United States, up until the early 80s, had a conventional cost-plus monopoly regulation of natural gas, and from that model, they moved directly to a competitive hub-based trading model. Whereas Europe did have a situation of oil price index dominance, but market liberalization in Europe is moving ahead, and right now, the share of oil price indexation in Europe is somewhere around 50%. I don't want to get into a philosophical debate whether is it below or over 50%, but certainly European gas markets increasingly can be regarded as real markets rather than computer games for traders. Now, if I multiply the dominance of oil price indexation with a record high oil price, that led to a divergence again of global gas markets. Again, this is a quite recent phenomenon. Up until, let's say, 2009, we believed that natural gas is globalizing. As you see, up until 2009, the gas prices in the major regions moved reasonably close to each other. Of course, North America was much more volatile, and the reason for this is that in the oil price index business model, very usually they smooth out the oil price fluctuations by some moving averaging of the oil prices. Whereas in the North American spot market, there was a much larger degree of price volatility, but prices converged to each other reasonably well. And then, in the past 3 years, what we have seen is that the excess production of shale gas in the United States led to a collapse of prices. The dominance of oil price indexation times $100 per barrel pushed Asian gas prices to an incredibly high level. And Europe is somewhere in the middle. Europe is somewhere in the middle because there is no shale gas in Europe, at least there is no meaningful shale gas production. There might be shale gas underground, there might be shale gas production in the future, but today it doesn't play any measurable role. So Europe relies on imports, but markets already function in Europe. So I would say that the difference between Asia and Europe is primarily not geological. The difference between Asia and Europe is primarily due to the different market institutions. Whereas the difference between Europe and the United States is primarily geological. So having as cheap gas as the United States is not a realistic prospect for any region which does not have a lot of cheap gas domestically due to geological conditions. Now, as a result of this increasing divergence, I must say that natural gas is the only important industry where globalization is defeated right now, and the main regions are diverging from each other. Unsurprisingly, this is actually a major rearrangement of competitive conditions, favoring the United States and disfavoring the expensive gas regions, most importantly Asia. My favorite example is SABIC, Saudi Basic Industries, which the Saudi government established to utilize their own domestic energy resources and build up a petrochemical industry. So the raison d'etre, the reason for existence of SABIC is the notion that Saudi Arabia has a lot of cheap energy, and that is a basis for competitive petrochemicals. Now, SABIC is now investing in the United States to take advantage of cheap gas in the United States. So this is the extent of the competitive rearrangement from the divergence of gas prices. Now, simply observing that a region has high prices, that doesn't necessarily mean that the markets are inefficient. If you recall my previous slide, before 2009, there were periods when North American prices were higher than Asian prices, because if you have an efficient market, or the supply-demand balance is tight, then the efficient market will deliver to very high prices. And this is exactly happened in the United States before the shale gas revolution. The conventional gas resources of the United States were declining, so markets had very high prices, and those very high prices were exactly the trigger for developing shale gas. But what we also see in Asia is not only high prices, but very inefficient pricing. Now, and the blue area in the chart is the dispersal of Japanese import prices in any given moment of time. So in any given moment of time, you can have an LNG cargo arriving in Japan at a price of $10 per MMBTU, and at the same peak you can have another LNG cargo arriving at $16 per MMBTU. Try to imagine if we did the same chart for crude oil. It would be one single line, because in crude oil, if you have a 1 cent per barrel price differential, the commodity markets will immediately jump on it, will immediately redirect cargoes, and will immediately have a very efficient trading activity, optimizing of sending the crude oil where the market value is the highest. We actually estimated that with this price dispersion, which is a very, very strong indicator of an inefficient market, you could actually achieve a $10 million efficiency gain by simply redirecting an LNG tanker from one Japanese port to another Japanese port. Okay, so we're not talking about building some very large infrastructure, we're not talking about some major developments, simply shipping to Osaka instead of shipping to Tokyo Bay. And that would deliver a roughly $10 million efficiency gain on one single tanker. And on average, Japan imports roughly 1,000 cargoes every year. So that's a major competitive inefficiency. And another aspect of the market inefficiency that we looked at is that there is a lot of media excitement about the big price differential between the United States and the Asia Pacific. But given that the United States currently does not have a liquefaction capacity, it might have in the future, but it currently doesn't have. So currently it is physically impossible to get gas from the United States to the Asia Pacific. And as a result of this physical barrier, it doesn't really matter how big the price differential is. From the point of view of the Asia Pacific gas market, the United States was as if the United States was on the other side of the moon. Completely locked out. North America is currently an island. Now, in the future, North America could play a very important role, but currently it is much more important to ask the question why we have a very large price differential between Europe and the Asia Pacific. Because whereas it is physically impossible to get gas without liquefaction from the United States to Asia, both Europe and the Asia Pacific are large LNG importers. Both of them have large excess gasification capacity. And LNG shipping, once you are on the sea, you can direct the cargo in any direction. And they estimated that given that Europe already has reasonably well-functioning markets, especially in the United Kingdom, the National Balancing Point, NBP, if we regard NBP as a well-functioning market, we estimated the shipping cost difference from the point of view of the major exporters, Qatar, Nigeria, and Algeria, to shipping cost to Europe versus shipping cost to Japan. And if you have a situation where it would cost you $1 more to ship to Japan instead of shipping to Europe, then in an efficient market, the Japanese price level should be $1 higher than the European price level. Now, as it turns out, the current Japanese price level, which is a very good indication for South Korea and Taiwan as well, is systematically higher than what could be explained by the European market prices and the difference in shipping cost. Our estimation was that the Japanese import bill is at least $10 billion higher than it would be in a well-functioning competitive LNG market where cargoes go according to price signals. So this is real money. This is a serious company product. Now, another thing that I would like to emphasize is LNG is the answer to every question which starts with what if. What if the restoration of nuclear power in Japan proves to be difficult and slow? Well, Japan will buy more LNG. What if non-conventional gas in China disappoints? Right? China will buy more LNG. What if China and Russia will spend another decade hanging each other on the Siberian pipelines? Again, China will buy more LNG. Now, given that LNG has this nature of providing strategic flexibility to energy policy, answering the question starting with what if, the LNG demand of a given country is inherently uncertain. And of course, the producers have a very, very legitimate interest for the recovery of their investment because LNG is very capital intensive. And they have a very legitimate interest in providing security of demand for them. But unfortunately, LNG demand is inherently uncertain due to this flexible nature of LNG. And just to give you an indication, if you ask the question of what happens if Japan does not go back to nuclear power, then the amount of gas that Japan would need times the investment costs of the current Australian projects is around $30 billion. Now, investing $30 billion into additional liquefaction capacity in Australia on the assumption that Japan will have one type of nuclear policy over the other, that's a very, very risky proposition. So anybody who invests in LNG today can very easily find itself into the situation of the previous generation of LNG investors who invested in LNG with the view of selling it in the United States, but the United States did not need it because of the changing market conditions because of shale gas. Now, that LNG found the markets elsewhere, mainly in Europe, some part of it is in Asia. So the key benefit of having a properly functioning Asian market, that your project, your export project is not locked into one single country. You invest in Australia, and then Japan goes back to nuclear, but then you have an efficient market and you end up selling it in Singapore and Thailand. So a properly functioning competitive market might not lead to very low prices. I should emphasize that liquefaction will never be really cheap. It's a very capital-intensive technology, so any region which relies on LNG will unfortunately face higher gas prices. The key advantage of markets is at whatever price level they provide us an efficient equilibrium of supply and demand, you will be able to sell your physical quantities and you are not locked into the policy developments of one single country. Now, how to get there from the current situation? Well, the approach is slightly different than it was in the United States and Europe for two reasons. One is the geography. Both Europe and the United States are largely continental systems, pipeline dominated. And the other, especially in the United States, the United States has more than 1,000 independent gas producers, and the largest company, ExxonMobil, has a 4% market share in the US market. So it had an incredibly well-diversified supply structure, and consequently, developing a competitive market was reasonably easy. The only thing you have to do is to have proper access to infrastructure. And that was the key in Europe as well. And this is where Asia still has some serious issues, that access to the infrastructure is not effective in most Asian countries. And I'm not saying that access to infrastructure is legally prohibited, because there are Asian countries where theoretically you have third-party access, but in practice, if you actually try to do it as a trader, then you will find a long list of difficulties. Now, there is nothing new in it. There is nothing new in it. The European experience shows that it was a decade-long process to establish effective third-party access, and you needed legislation in place. And also, very, very importantly, you needed competition authorities who had real teeth and were effective in actually enforcing this. So at the first stage, we have to establish third-party access. We have to establish the right of the consumers to choose supplier and the effective ability to choose supplier. And in the second stage, we can move to linking it to financial markets and derivatives. I should warn you that very, very often the government instinct is to establish our futures market. The derivatives are very sexy. Unfortunately, a derivatives market without a well-functioning underlying physical market is just a casino. It will not pay. First things first. So first you have to have a well-functioning physical market for the commodity, and when you have that, then the derivative market will follow. Now, another important lesson is that there are powerful interactions between electricity markets and gas markets. And a well-functioning competitive electricity market is an enabling factor for gas market development as well, for several reasons. It's very difficult to establish retail competition for small clients because of the transaction costs of choosing supplier and the barriers to build up a retail portfolio. But electricity companies consume very large quantities of gas, and they are also well-capitalized professional companies who have expertise in commodity trading. So once you establish electricity market liberalization, they will have a very powerful incentive to optimize their portfolio balancing. Empirical evidence shows from the United States, which is a very, very good case study. In the United States, the electricity industry is a time travel from the 1920s to the 2020s. The United States has some markets in the Northeast United States and Texas, which are very competitive, very well designed, use all the modern IT technology, and they really the 2020s. And also the United States has electricity markets, which are 1950s style, conventional, vertically integrated monopoly regulation. And there's a very strong empirical evidence that in the competitive regions of the United States, there's a much more elastic substitution between coal and gas. There's a much more efficient fine-tuning of the power plant portfolio as companies react to market signals. With a bit of a simplification, if I'm a vertically integrated monopoly utility and I have a cost-plus regulation, so I can pass all the fuel costs to my consumers, why would I care? Of course I don't. The other important role of the electricity companies that as large gas consumers, they can potentially play a role in developing new gas sources. This is very much happening in Europe. Several large companies which we conventionally thought as electricity companies, like Iberdrola or electricity ones, are actually playing an important role in developing new gas supplies and as a result creating more competition in gas markets for their power plant portfolio. This started to happen. For example, Chubu Electric Power from the major Japanese electric utilities just established a trading office here in Singapore. I wouldn't be surprised at all if other major Japanese and Korean energy companies follow this. Now, another important change which actually creates better prospects for energy trading is the increasing diversification of the supply participants. Traditionally, the Asia-Pacific LNG trade was like a ferry. It was a ferry from Indonesia to Malaysia to Japan and Korea. So the LNG tankers were shuttling back and forth in one route. But if you take a look at the map, what you can see is now there is a mosaic of various energy projects with all the usual suspects, all the oil and gas super majors involved. And I should emphasize that when we tend to call these companies international oil companies, but this is a historically outdated thing. In the past 5 years, for the top 5 super majors, their combined oil production is down by 500,000 barrels per day, and their combined gas production is up by 700,000 barrels per day. So much more than 100% of their growth is coming from gas production. So these are international gas companies who historically in the 20th century were international oil companies, but that's the past. And LNG is of course playing a very, very important role in their strategy. Now, don't get me wrong, most of the projects where you see the logos are projects where the upstream investment was developed on the basis of long-term contracts with oil indexation. So, nevertheless, these companies have the trading capability to redirect cargoes from one